Hey everyone, the 10-year Treasury hit an all-time low last week as financial markets reacted to the spread of the coronavirus. Before I focus on what this means for commercial real estate, I want to offer an update on the impact of the coronavirus in follow-up to the video we released a few weeks ago. Now on that video, I pointed out that the January drop in the stock market and interest rates was temporary. But I also pointed out that the underlying assumption was that the coronavirus would be contained in China. But now the virus has spread, with people being diagnosed in Italy, Iran, and other parts of Asia and Europe. So the virus is no longer contained. That said, most of the guidelines I previously offered regarding the implications for commercial real estate still hold. Because the virus has spread beyond China, a pandemic scenario has become much more likely. And that is what Wall Street is reacting to. Now, from an economic standpoint, the coronavirus could shave 50 to 100 basis points off the first quarter US GDP growth rate. If that happens, first quarter GDP growth would remain positive, but it would be somewhere between 1% and 2%, slower than we have seen for the last few years, but still growing. This reflects an expected softening of U.S. exports, reduced tourism, and a potential slowing of retail sales growth as the supply of some products and materials manufactured in China declines. However, once we put the coronavirus behind us, like we did with the bird flu, SARS, and the swine flu, we should see a bit of a bounce in growth as supply chains are refilled. The threat to the economy is what Wall Street is reacting to, and why traders have moved capital from stocks to the safety of bonds, driving the 10-year Treasury rate to a record low. So what does this mean for real estate? First, although there could be some softening in economic growth, the likely impact on job creation should be modest. We currently have more job openings than people looking for work and a near record low unemployment rate. So job creation should remain positive. As a result, overall demand for commercial real estate should remain positive as well, but we could see the pace of absorption in industrial and retail properties moderate a bit as companies become a bit more cautious in their expansion plans. Hotels, particularly those catering to international travelers, could see weaker occupancy rates and flattening ADR growth. Demands for apartments, self-storage, and office space will likely see little impact. The biggest consideration for investors, though, is the significant drop in interest rates. The yield spread between the 10-year Treasury and cap rates has reopened to 500 basis points, one of the widest spreads on record. So levered yields are exceptionally strong right now. The availability of capital remains very good, and just to give you an example, recently some investors working with Marcus & Millichap Capital Corp, our mortgage company, locked in 3% loans. Of course, there are a lot of variables tied to lending rates, including leverage, borrower credit, asset type, location, etc. So mortgage rates will vary for each borrower and each deal. But this extremely low cost of capital represents a unique and limited window of opportunity for investors. Although it's possible that rates could drift lower, locking in 3% debt is a pretty rare opportunity.